Welcome to another edition of Insurance Explained with Andrew Perlin. Thanks for being here. People are very concerned about market corrections when it comes to their retirement, but for some reason, people aren't taking into consideration if they're underinsured. So that's what we're going to talk about today. So, homeowners insurance, there's a lot of ways that you can be underinsured while still having a homeowners insurance policy. And if you are underinsured, you could be costing yourself a lot of money. And where is that money coming from? Well, obviously, it's coming from your retirement or your income. So for most people, a home is their most valuable asset. It just is. You spend more money on your home than anything else. It's going to appreciate probably better than most of your investments, all things considered. And we want to make sure that it is protected. So when you're talking about a home policy, there's three things that we're trying to protect against. We're protecting against the damage to the dwelling, personal property, and of course, liabilities. If done correctly, your homeowner's insurance policy will cover all three of those things. Now, let's think about this in terms of what are we actually covering? The structure itself. In certain cases, that could be 500 to $1 million or more. That's a lot of money. That's number one. Number two is personal property. Okay, personal property is the things that you bring into your house. There's a reason why personal property is at least 50% of the dwelling amount, typically speaking. There's a reason for it because stuff costs money and it's a lot of money, and people don't want to have to drop a couple $100,000 on clothes, furniture, electronics, and appliances just to get back to where they are. And then, of course, liability. If someone hurts themselves due to your negligence, they fall down the steps, something happens, the next thing you know, they are in the hospital and you are now responsible to fix their physical well-being. That can cost hundreds of thousands of dollars. And my opinion of it is that you should be more concerned with your homeowner's insurance than a market crash. Like I said before, depending upon when the market crashes or corrects, you can recover. Homeowners, if it's not there when you need it the most, could be writing a really big check. So let's take a look at some of the things that are causing people to lose their money when it comes to a homeowner's insurance policy. All right. First one we see a lot of is sewer backup. We all know that groundwater is considered a flood, and flood is not covered by any homeowner's insurance policy. If you feel like you need a flood policy, you have to buy that separately. Okay, most homes are not in a flood zone. So right off the bat, people think, I don't need a flood policy. All right, here's the deal. Water that hits the ground and then somehow gets into your house and causes damage is considered a flood. If you're not in a flood zone, but there's a torrential downpour and water gets into your basement and floods it, that's a flood, not a homeowner's problem. It's not going to cover it. Okay, but what we do see is sewer backup or water backup. Almost all these new homes now have a sump pump. They do that to mitigate the issue from a water perspective. Every so often, the pump itself will fail. It'll just burn out or whatever, and water comes through the hole and it floods your basement. Homeowners insurance will not cover it without sewer backup. Okay. Now, you're probably thinking every policy comes with it. Wrong. You have to add it. The minimum that you can put on a sewer backup that I'm used to seeing anyway is $5,000. So now what happens if the sump pump fails, water gets into your basement, and now you got this problem? If you don't have sewer backup, it's not going to cover anything. Now you might be saying my policy has $200,000 worth of personal property. The only way your personal property will be covered in a scenario like that is if you have sewer backup. If you don't have it, it's not covered. Personal property is not going to take care of it. So if you have a finished basement and you have $5,000 worth of sewer backup, mitigation alone is probably somewhere between $7,000 to $10,000, if not more. So right off the bat, you're already in the whole $5,000 just to dry your basement out. Now we're talking about replacing everything. If you have any kind of flooring down there, it's going to get destroyed because of the water. That's got to go. If it damages the drywall, that's got to go. Any personal property that's in your basement due to the sewer backup issue is covered under sewer backup. And if you don't have enough, it's not going to get covered. I have seen some pumps fail and people are out 20, 30, 40, in some cases, $80,000. That's a big number. Can you write that check? If you can, leave it where it is. If you can't, then make sure that that's covered properly. That could be worse in certain situations than a market crash. Sewer backup is a big one. The next one we see is, of course, replacement cost. Replacement cost is just the amount of money that the insurance company thinks they need to rebuild your house from the foundation up. The problem with replacement cost is it is a static number. So if prices spike, there could be a delta. Now, there's ways to fix that, meaning the insurance company will look at that thing every couple of years to make sure it's right. And there's additional replacement costs that you can tack onto it, upwards of 25, in certain cases, 50% of coverage A, which is fantastic. But if you don't have that and prices spike, we're talking a lot of money. Another example is if you do any kind of major renovation to your home and you don't tell the insurance company that you've upgraded your kitchen and your bathrooms and they think it's builder's grade and now it's custom, you're going to be missing out on a lot of money. I see this all the time. We've talked about it in episodes past where people finish their kitchen, they drop 100 grand on their kitchen, never decided to tell me that they did it. And then, of course, the replacement cost is too low and there's a total loss. They're like, what am I going to do now? You're going to come out of pocket. Could you imagine losing $100,000? It's worse than a market crash. So make sure that your replacement cost is up to date. Ordinance of law. Now we're seeing this a lot with these older homes. So what's ordinance of law? So basically what it's saying is if there's any damage to your home and it needs to be rebuilt or repaired and it's not to current code, no contractor can build to old code. So they have to rebuild to current code. So you can either pay for that out of pocket, or you can have ordinance of law upwards of 10 or 20 or 30 or $50,000 to rewire and rework your entire home. This is a huge gap that needs to be taken care of. Roof coverage is another one. Since COVID, we've been seeing that insurance companies are now taking roofs by their age. And they're saying, okay, if you're somewhere between 15 and 20 years old, we're just going to reduce the coverage. We're only going to cover a certain percentage of your roof. What we've been seeing a lot lately is they change it from replacement cost to actual cash value. What's the difference? Replacement cost means they're going to replace it like in kind. Actual cash value means they're going to depreciate the roof based on how old it is and then give you that number. If you have actual cash value and your roof is 20 grand, they will depreciate it because it's 15 or 20 years old and then give you whatever that number is after depreciation. And that could lower it from 20 grand to $8,000 or $10,000, depending upon what kind of scale they're using. Insurance companies are moving more towards ACV, or actual cash value, for older roofs because they do not want to be on the hook to replace your entire roof unless there's a huge issue. They also want you to have new roofs. So their way around that is if you're not going to get a new roof, you get the 50-year shingle and you're going to wait 50 years to get a new roof, well, we're just not going to pay a full replacement cost on any kind of issue. We are just going to give you ACV. If you have an ACV policy, I strongly recommend that you back on replacement costs because that could cost you a lot of money. Service line is another one. Once the utilities bury a service line on your property, it becomes your responsibility to fix. So if something breaks on your property, that's you. The utility is not going to pay it. You have to pay it. A sewage line coming from the street to your house breaks on your property, that's $10,000 right off the bat, not to mention the damage that it caused. So that could be a huge issue for you. But just understand that there's a lot of gaps out there that can cost you a lot of money. In certain situations, this money that it cost you could be worse than a market crash. And I'll take it a step further. You're missing out on the opportunity of that money being invested. So now I got to take $20,000, $30,000 out to fix whatever my issue is. That's $20,000, $30,000 less than retirement, plus whatever that money was going to appreciate by it being in the investment account. Okay. Now you're probably saying these things don't happen all the time. Wrong. These things happen all the time. So it's just very important that you understand that this is a financial issue for you. This isn't just an insurance issue. This is a financial issue. This is how people protect their assets, by being properly insured and making sure there are no gaps. It's not the big obvious risk that people see. They get it. They're like, oh, we got to fix this. It's these small things that people just aren't ready for. Your insurance won't change unless you change it. And if something's changed in your life, you need to review it. So let's talk about it. Again, I want you guys thinking that insurance is not just something that you buy because you have to. It's something there to protect your assets. And if you look at it through that lens, my guess is that I'd rather spend more money on the insurance policy than have to write a check for 30, 40, 50, 100 grand, because that will derail everything. Homeowners insurance, it's getting expensive in Maryland, like it just is. But again, I'd rather spend another $1,500 a year than have to spend $150,000 because I wasn't properly covered. So listen, if you have any questions about homeowners insurance, leave it in the comments. I'll be more than happy to review any policy that you're interested in me reviewing. I'm not trying to sell you anything. I'm just trying to give you information. The more information you have, the better decision that you can make, the better prepared that you'll be when something happens. My job as an insurance agent is to protect people's assets. That's it. I use insurance to do it. I would much rather take your asset and protect it and move the liability from your personal balance sheet to the insurance company's personal balance sheet. I hope this was helpful. I really appreciate you guys being here. Please like and share the link below. If you're interested in having any kind of review, just let me know and I'll be more than happy to review anything. Like I always say, life changes. Your insurance and the policy needs to change with it. All right. Thank you very much for being here. I do appreciate it. Have a great day, everybody. This is Andrew Perlin with Insurance Explained, and I'll see you next time. Take care. Bye.